company. Gulf Oil is the first management on the show. The stock has surged nearly 60% this year so far. So it reported what was a good set of Q2 numbers, largely on the back of stable input costs and a better product mix. To discuss demand trends and opportunities in the EV infra space, we have with us Ravi Chawla, who is the MD and CEO of Gulf Oil Lubricants, who joins in now. Mr. Chawla, hi. Thank you very much for taking the time out. Well, you know, we haven't really spoken to you post your Q2 numbers, where your revenue was up around 11.5%, margins at around 12.5%. Could you just detail for us what the volume growth was like and what are you targeting for the entire fiscal? What could your exit run rate be?
So normally we do 2 to 3x the market growth. That's what we target. So industry is going to grow at 2-3% as it has been growing, and it will continue growing at that rate. So for us, our volumes in core lubricants, definitely we saw a good rise in that. At Q2 we were at about 6.3% volume growth, and H1 we are at close to 5%, 4.6 to be exact. So good volume growth. Different segments that we cater to: B2C, B2B. We have the replacement market, we have OEMs. So obviously we are seeing good growth across our segments. And as we have been, growing that 2 to 3x, we are pretty confident that we will continue growing. And definitely the industry also is going to grow at 2 to 3% in terms of volume, and value will be much higher. And we feel that definitely this is our target, to continue growing and gaining market share.
Okay, all right. So 2 to 3 times the industry, which is growing at around 2 to 3%, that is the target. We've spoken about how the base oil, which is a derivative of crude, impacts margins. Crude prices have come off substantially in Q3 so far. What is the exit run rate looking like for margins? Will product mix change? Will raw material stability lead to better margins? You are at around 12% in Q2.
Yeah, you're right. So when there is stability, obviously the pricing remains steady in the market, and one can go into product mix in segments with, pricing always is there. So there is a lag time usually when the crude goes up 2 to 3 months, because base oil, different grades, different supply demand conditions are there. So we definitely see that stable pricing will have. There was some increase in crude a few months ago, as you saw. So there is a pass on and a cut down in terms of the lag time. With the B2C business, it can be put into the market, whether it goes upwards or downwards. Sometimes there's adjustment on the schemes. For B2B, which is OEM, etc., there's a price variation clause. So definitely stable pricing will be good. There had been some increase in the additive prices, which are the chemicals which we put into lubricants. But base oil is now looking, with the crude being, as you mentioned, steady. It is obviously going to see a steady raw material scenario, but we definitely need to wait and watch how things play out.
Okay, can you just detail to us how much capex are you probably looking at when it comes to the EV space? Because you've recently announced a JV for high-power EV charging stations. Separately, we do understand that you made an acquisition, Tirex, which is a manufacturer of DC fast chargers for EVs. So just detail to us what your plan is within this space, the capex which is likely to be deployed, and what are you looking at in terms of, say, revenue?
Yeah, so we have a normal capex for our lubricant business, which is around 25 crores. We are generating cash. Last quarter we generated 140 crores. We have good cash on our, with us, and we are debt free. So what we have done is we've looked at the spaces where, in the EV value chain, EV mobility value chain, where we think we can, make some impact. Of course, these are investments which will take time. So we have made this investment in the Tirex, which is a DC charging company. Currently, they are very good in terms of technology. They have over 500 sites of DC chargers, which they make from 30 kilowatts to 240 kilowatts. They can cater to, chargers for buses, chargers for cars, the fast charging DC market. And they have been a good, strong technology-based player with good service, good product. And they have about 7-8%, 8-10% of market share today. As the market grows, we would definitely expect, we have put in about 100 crores, which is mainly going to go into expansion, building the technology and the service team. And definitely we are looking at this business as the chargers market grows in India. We see that if Tirex is able to get that 7-8-10% market share, it will definitely be a good company. We are going to work with them along with leveraging our strengths, and feel that this business is going to be a good business going forward. The figures are all up for discussions because we don't know the penetration. But even if we estimate that there's a demand of 1 billion for chargers, and the fast chargers are 15%. It's a huge market which can develop in the next 5-7 years. And the current market share could see a good revenue. And there are 4 segments they will cater to, basically the petrol stations, the PSUs, electricity boards, the charge point operators, the OEMs who make buses, other EV vehicles, and definitely the retail. So 4 segments clearly identified, and we hope that the revenues will multiply quite rapidly. And for us, this is a charger which we will sell. So we will sell the charger and obviously get returns on that. We are not getting into charging as being a charge point operator. So it's going to be a straight product sale with definitely the benefits of...
Last quick question, because we're short on time, Mr. Chawla. What would the margins on this particular product look like? Will it be higher than the current margin profile?
So very good question. So we are looking at similar and incremental. Of course, there are 4 segments they'll cater to, but hopefully it will be similar to the margins we make today.
Okay. All right, sir. We're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's the word coming in from Gulf Oil. Just before we take a break, just want